Hello and welcome. In today's video, I am analyzing Essel Propack Ltd. EPL manufactures multi-layer plastic laminated collapsible tubes, providing specialty packaging solutions to fast-moving consuming goods sector. The company has filed over 160 patent applications, of which 66 patents were granted. EPL has a global presence and operates in 4 geographical segments: Africa, Middle East and South Asia. That is 30.4% contribution to the total revenue in FY21 came from these countries. East Asia Pacific contributed around 23.7% to the revenue. America contributed around 21% and Europe around 24.9%. The company has an established position in the global oral care tubes market, commanding more than a third of the global market share. The oral care segment accounted for 54% of the company's revenues in fiscal year 21. In fiscal year 20, the contribution to the revenue was around 55%. EPL also caters to the personal care segment, which includes pharmaceutical, beauty and healthcare products and food industries. As the personal care segment offers higher Ebitda margins than the oral care segment, the company has been focusing on increasing the former's revenue share. First quarter FY 2022 contributed around 46%, whereas FY 21 of the same quarter contributed around 46%. EPL benefits from backward integration as it is engaged in an end-to-end process. The company manufactures plastic laminate sheets at its plants in India and China and supplies them to other plants which convert these sheets into tubes. This is followed by the printing and capping of tubes before they are sold to customers. EPL is increasing the in-house manufacturing capabilities for caps and closures, which would provide further integration to the operations. The company sells around 8 billion tubes annually. Despite the tough operating environment due to the increasing raw material prices and supply chain disruptions, EPL's 12 trailing month consolidated revenue grew 9.6% year-on-year in first quarter FY 2022 to INR 31,482 million, driven by growth across AMESA. That was a growth of around 13.5%. In EAP region around 14.5%. In America around 5.1% and in Europe 3.6%. The company's Europe operations would be impacted in the short term by the closure of its Russia manufacturing operations. Major raw material prices such as liner low density polyethylene and high density polyethylene have increased by over 50% over the last 12 months and remain elevated. Global container shortages and port congestion has led to a sharp increase in logistic cost as well, while also leading to certain loss of revenues. The consolidated 12 trailing months Ebitda margins declined to 19.4% in first quarter of FY 2022. In first quarter of FY 2021, 12 trailing months, the Ebitda margin was around 20.7%. Due to the increased costs which are passed on to the customers only after a lag of 1 to 3 months. While supply chain related disruptions and elevated raw material prices impacted the operations during fourth quarter of FY 2021 to first quarter of FY 2022 and are expected to persist for the remainder of FY 2022, some recovery is expected in margins over the remainder of the year owing to price increases taken across the portfolio. The company is projected or expected to report stable revenue growth of 6 to 8% over 22 to 23 from higher realizations and stable volumes, and the Ebitda margins at around 18.5 to 19% in FY 2022, improving to around 20% thereafter. EPL's 12 trailing month interest coverage, that is Ebitda over the interest expenses, improved to 17 times in first quarter of FY 2022, which was earlier 10.2 times, due to the improvement in the scale and lower interest costs. The company reduced its interest expense by lowering the borrowing costs. Based on the estimated net adjusted debt of about 4,000 million Indian rupees as on 30th September 2021, the net adjusted leverage, that is net adjusted debt upon Ebitda, remained at around 0.7 times, which was earlier also at 0.7 times for the 12 trailing months first quarter FY 2022. The credit matrix is expected to remain strong over fiscal year 2022 to 23, driven by healthy operating profitability and the company's prudent debt-led capex policy. As on 30th September 2021, the Blackstone Group, through Epsilon Bidco Ltd, which is an affiliate of funds managed or advised by the Blackstone Group, it owned 51.91% stake in EPL. In FY 21, the stake is 51.96%. Blackstone is a large global alternative asset management company with assets under management of over USD $510 billion and a track record of around 30 years. The presence of Blackstone brings professional as well as technical expertise in the packaging sector through its portfolio companies that are spread across the globe. Blackstone may continue to leverage EPL's global leadership position in the oral care segment and accelerate growth in the personal care segment as well as in new geographies. As the sponsor, Blackstone also provides robust financial backing to EPL, improving its financial flexibility. The company has estimated cash and cash equivalent of about 2,165 million Indian rupees as on 30th September 2021. With the exception of FY19, EPL's free cash flows was positive during FY15 till FY 2021. In FY21, it was 1,549 million. In FY20, it was 2,000 million. Due to strong operating profitability, a stable net working capital cycle, which was 125 days in fiscal year 21 and 123 days in fiscal year 20, and despite increasing dividends, which was around 1,341 million in FY21 and 888 million in FY20. In FY19, it was around 478 million. Expect the free cash flows to remain subdued but positive over fiscal year 22 till 23 on the back of stable operating profits, a stable working capital cycle, but higher capex and dividend payouts. The company follows the policy of keeping the average capex for a year equal to the depreciation amount, except for some strategic investments that may lead to higher capex in certain years, as in fiscal year 19. EPL continues to face competition from unorganized players due to the low entry barriers in the industry. Also, the company remains susceptible to a demand slowdown in the regions where it operates. However, long-standing customer relationships and EPL's focus on innovation to cater to customer needs mitigates the competition risk to a large extent. Volatility in raw material prices, that is, crude derivatives, is another risk that the company has been managing effectively via pass-through clauses in its contracts, albeit with a lag. Given the global footprint of the company, EPL is also exposed to foreign exchange fluctuation risk, though this too is being managed effectively through the incorporation of necessary clauses in the pricing contracts, use of forex risk management measures such as forward contracts, as well as the presence of a natural hedge from the overseas borrowings. Oral care products contributed around 54% to EPL's total revenue in financial year 21, exposing the company to a substantial segment concentration risk. However, EPL has increasingly been focusing on enhancing the revenue share of the personal care segment, that is beauty, cosmetics and pharma, among others. The risk is further mitigated by the presence of stable demand for oral care consumer products. EPL has been focusing on research and development. The total cost incurred in financial year 21 was 212 million rupees, and in financial year 20 it was around 156 million rupees. EPL has 19 manufacturing plants in 9 countries across the world. The company's Russia manufacturing facility was shut down during financial year 21 to consolidate its European operations. From here on, we'll move on to understanding the company's financial data, that is, data extracted from the profit and loss account, balance sheet and cash flow statement. So let's start with the analyzing of the financial data. So I'm comparing Essel Propack Ltd with Jindal Poly, Uflex and Polyplex Corporation. The current market price for EPL is 193 rupees with a face value of 2, whereas all the other 3 companies face value is at 10. So approximate price is 5 times of 193 rupees if you want to compare each company's price with a base face value of 10. The highest fall is seen in Essel Propack Ltd at around 34% from its 52-week highest point it had reached. The lowest fall is seen in Polyplex, which is also a bullish sign by the investors, which are giving it a lot of confidence in the company. Uflex also has fallen the least at around 5.92% from its highest point. Jindal Poly has fallen around 22%. So the more the fall, the higher the weakness that is seen in the stock, and it's a sign to investigate actually what is, are the fundamental data intact or has the fall because of some other reason. The quarterly results are up to date till December 2021. Let us look at the sales growth over its previous quarter, that is from December 2020 to December 2021. All these companies have seen their sales grow by around in a double-digit growth rate. EPL's sales have gone up by 14%, whereas highest growth rate in sales is seen for Polyplex and Uflex. If we look at the sales growth rate, quarterly profit growth rate rather, we see that EPL's profits have seen a degrowth of almost 19%, and that is why we can see that the stock has fallen quite a bit because of the degrowth in its profits. Jindal Poly has also seen a low growth of around 10%, and that is why it has impacted in the price of the stock. Whereas both Uflex and Polyplex profits have gone up quite substantially. Also, we need to look at sequentially how the profits has grown when we see such high growths in profits or sales, to see whether the sales over sequential period is growing in a steady manner upside. Sales of 2021 compared, that is March 2021, compared to the recent 12 months, as of fiscal year or year ending March 2021, total sales done by Polyplex was 4,900. Against that, the current sales has gone up to 6,000. EPL's sales has also gone up from 3,000 to around 3,300. Jindal's sales has gone up from 4,000 to 5,300 rupees, 300 crores rather, and Uflex sales have gone up from 8,800 to 11,000. So as far as in terms of sales are concerned, Uflex is doing the highest amount of sales or generating highest revenue. Now, is that revenue also getting converted into cash? That needs to be seen. Moving forward, we'll compare the financial year March 2021 ending profit after tax. Compare that with the 12 trailing months profits. Polyplex profits have dropped little bit from where it was in FY21. Same is the case for EPL as well, from 250 crores to 222. Jindal's profits have gone up from 783 crores to 912 crores, whereas Uflex has also gone up from 844 to 1012 crores. You also need to check whether the profits are getting converted into cash. So both these data is as of 31st March 2021. So Polyplex cash flows are almost double of the profits declared. Same is the case with EPL. From 250 crores of profits declared, the cash coming in through operating activity is 522 crores, which is a good sign. In fact, we see that in almost all the companies that cash flows are more than the profits declared. Let us look at the valuation ratio, price to earnings. The lower the better, but that does not signify the quality of the company, it just shows that it is available cheap. So we see the highest price to earnings is of EPL as of today. So although the share price have fallen and the earnings have also dropped, but the price of the stock has not dropped that considerably compared to the earnings, or vice versa. So even now EPL is quite expensive as far as price earning is concerned, because if you look at its 5 years price earning, that was going at around 19 times. So we'll need to wait for it to come down to at least 19 times in terms of price to earning. Even industry price earning on an average is around 12 times. Compare that with Polyplex, so it's 5 years average. All of these numbers will need to be reinvestigated by someone who is interested in investing in a particular company. This is an educational video. So do not take this as an investment advice. Polyplex is trading at around 15 times its earnings, which is slightly above its industry average. Jindal Poly is available at its 5 years average and way below its industry price earning. Same is the case with Uflex as well, at 4 times its earnings. So valuation wise, EPL is most expensive, at least earnings wise. Next we'll look at the price to operating cash flow valuation ratio. Here too we see EPL is the most expensive at around 11 times, followed by Polyplex at 7 times its operating cash flows. Jindal Poly available at 5 and Uflex at around 3 times its cash. So we want the price to OCF, or rather we should trust price to OCF more than what we would trust on price to earnings. So the lower the better. So price to OCF for EPL is good at a good range of around 11 times. Next we'll look at the price to book and compare it with its industry average, which is at around 1.44 times. Again, Uflex is trading below its book value. Now this needs to be investigated as to what is wrong with the company. Why is it trading below the book value and also below the industry price book value? Jindal Poly is trading at around 1.5. Most expensive again is EPL at 3.46 times its book value. Polyplex is available at 2.47. This also signifies that people are willing to pay a higher premium for a company as far as book value or as far as earnings are concerned for EPL. Now there has to be some reason for that, why investors in the market are willing to pay a high premium compared to other companies. When we look at these sales and compare it with how many times more is the market cap, we again see the same scenario where EPL is trading at the highest price to sales ratio of 1.81 times, followed by Polyplex at 1.2. Both Jindal Poly and Uflex market cap or market capitalization is lower than the amount of revenue it is generating or has generated in the recent 12 months. As far as the Ebitda is concerned, that is earnings before interest, tax, depreciation, amortization, and comparing it with the enterprise value, here too we see it is EPL is available at 11 times its Ebitda. So we are buying quite expensive. Now compare that with Polyplex and Jindal trading at 5 and 4 times and Uflex at around 3.85 times. Now all of these companies are into packaging sector or packaging industry. So we have to, maybe they do not have the exact same product profile, but they can be generally categorized under the packaging industry. Next we'll look at the sales growth and profit growth, which is very important to look at. It should be in positive figure, above 5% at least. So all of these companies except for Jindal Poly have seen their sales grow at least in the single digit for both 5 years and 3 years. Jindal Poly has seen a degrowth of around 10% in its sales from 5 years back and 14% degrowth over 3 years back, whereas Essel Propack has seen 7 and 8% growth rates in its sales. We see profits also growing at 8 and 12% for Essel Propack. Now, whenever we see a very high growth in profits like 77% and 47%, this needs to be investigated as to why the profits have grown so at such a high double-digit growth rates. Now, this could be because that 5 years back the profits may be quite low, and today compared to that it is quite high. Or 5 years back the profit could have dropped and now it has increased back. So then it will give an inflated figure of around 77 and 47%. Generally, around a growth rate of 5 to 15% is a reasonable growth rate for profits and sales. Anything above that needs to be doubted. Same is the case for Jindal Poly, where we see that although the sales of the revenues that is the company is generating has seen a degrowth, but the profits are still growing. Now this again needs to be investigated as to why this is happening. Uflex sales are growing at around 6% over the period of 5 years and 9% over a period of 3 years. Yet the profits are growing at a higher, about 20% of growth rate. So this too needs to, all these companies, 3 companies needs to be investigated if somebody is interested in investing in them. If we look at the return on equity, we want this to be at least 15%. EPL's average over the last 5 years of return on equity was 15%. Currently also it is at around 15.4%. But in the recent 3 years, the ROE has dropped to 14.9%. 15 is the benchmark. Polyplex's long-term ROE is quite low, so this would discourage me from investing in the company. I'll still look at other ratios, but currently it is at 16.8%. Same is the case for Jindal Poly, earning less than 15% over the last 5 years. Uflex ROEs are quite low at 10 to 11%. Checking the ROCE or return on capital employed, here too it should be above 15%. For EPL, the long-term averages are at 16.8 and 16.7%. Polyplex is generating a higher return on capital employed of 17 and 20%, whereas the latest is around 26%. Uflex return on capital employed is quite low at around 11%. If we look at the return on assets, that is how well the company is generating profits on the assets employed by the business, the higher the number the better. There is no benchmark for this. But if you look at the companies EPL and Polyplex, both have generated around 8 and 9% or so, a higher value compared to Jindal and Uflex at around 5% each. The long term, this is the long term average values, but in the recent 12 months, if we see, EPL is very near to its average, which is a good sign, whereas all the other companies have shown a higher growth in their return on assets over the recent 12 months. Next, let us look at the asset turnover and inventory turnover. That is how well these assets or these inventories are being converted into sales. So the higher the number, the better it is. As far as assets are concerned, EPL has done the highest sales compared to the assets employed into the business of around 1.07 times. All other companies also very nearby, above 8 times or 0.8 times its assets. Whereas inventories for Poly, EPL and Jindal are both at around above 3.3 times its inventory holding, which is again shows efficiency or inefficiency of the management. Uflex is converting its inventory 5 times. Now we need to compare these to their long-term averages of 5 and 3 years. You'll need to do a little bit more work to get those numbers. Next is the net block, that is how much assets are currently deployed into the business. So we see Uflex has deployed the highest asset in the business at around 6,200 crores compared to its balance sheet size of around 12,000. So almost 50% of the balance sheet is in the fixed assets. EPL's fixed assets are around 1,500 crores compared to its balance sheet size of around 3,100. Again, almost 50% of the balance sheet is in the net block. We can also see by the balance sheet size which company is bigger in terms of balance sheet size. Uflex is the biggest one of them, followed by Polyplex and Jindal at around 5,300 crores. EPL's balance sheet is quite small and they have a potential to grow further. If we look at the capital work in progress, that is how much assets are being developed as of now or in the process of development, that is the capital assets. We see that anything above 30 or 40% of the net block creates an opportunity or shows the growth of or rather shows the growth stage of the company. That is, the company is developing more and more assets. But in all of these all four companies, we don't see any further or high investments in capex as of now. Next, we will compare the profits of the last 5 years and compare that with how much cash is flowing in from operating activity, and out of that cash, how much is free cash flows. For EPL, we see that last 5 years it has generated around 998 crores of net profits. Of that, 2,000, or rather almost double of that, has come by way of cash. As we had earlier seen for 1 year data as well, all these companies have generated double the cash of the whatever has been declared as profits. It signifies that they may be having a high depreciation cost, which is reducing the profits. As we can see, in all of these companies, almost 50% of their balance sheet is in fixed assets. So a high depreciation cost may be involved in that. So double of that is in cash flows, and of that cash flow, 50% is free cash flows for EPL, which is a very good sign. This is the ratio that I generally look at for all my companies. If we look at Polyplex as well, 1,450 crores of profits and almost double of that in terms of cash flows from operating activity, and half of that again free cash flows. Again, a very good ratio between all three variables. Same is the case almost with Jindal Poly, although their free cash flows are quite low, which signifies that they are investing heavily in assets or buying fixed assets. Uflex free cash flows are negative, which again is suggesting that entire cash that they have generated over the last 5 years is utilized or pumped back into the business for buying or acquiring more assets. So therefore we see such high asset base or net block in the company at 6,200 crores. This is not bad, provided that they are also generating higher returns on the assets. If they're pumping so much money into buying assets, then they should also generate a higher ROAs. We can also compare the cash flows earned against the balance sheet size. So the balance sheet size is 3,172 crores for EPL as of financial year 2021. Against that, they have generated more than 50% in terms of cash from operating activity. But when you look at the profits are not around 50%, rather it's less than 50%. But free cash flows are around 40% or so. So again, this also signifies how well the company is generating cash or profits against the assets employed into the business. Here too, we can see the same scenario for Polyplex. For Jindal, 5,300 crores of balance sheet size and 3,000 crores, again more than 50% generated by way of cash against the balance sheet size. But we don't see a good free cash flows available in the company. For Uflex, we see that the free cash flows are negative compared to the balance sheet size. So although company has generated less cash flows over the period of 5 years compared to the balance sheet size as of today, so there is some kind of pressure here in terms of generation of cash. Company should have generated a net profits of approximately, if we compare this with the other three companies, at least 30% or 40% in profits and double of that. So the CFO should have been at least 6,000 or so, and at least 20-30% of the CFO should have been in free cash flows. But company in its own wisdom is deploying a very high level of cash back into the business. Not necessarily bad, but we do want to see a good returns when the company is putting so much money back into assets. We want it to generate returns or profits or cash. Next, we'll look at how the valuation of the balance sheet compared to the market cap. How are they? What is it suggesting? So company's balance sheet size is 3,100 and it is trading at 2 times its balance sheet size. Polyplex is trading at almost slightly above its balance sheet size. Jindal Poly is trading below its balance sheet size, and Uflex is trading at a very high discount, 1/4 or only 25% of its balance sheet size. So although this creates an opportunity, but we need to understand why Polyplex is trading at such a high discount to its balance sheet size. I like to invest in companies which have at least a net worth of around 1,000 crores. So all of them are within that limit or above that limit. Contingent liability is very important to check. Polyplex has a very high contingent liability. This should not exceed more than 20% of the net worth. So here we see that this is almost more than 30% for Polyplex. Contingent liability is more than 30% of the net worth. EPL has a very low contingent liability of approximately around less than 5% or so, somewhere around 5% or so. Jindal Poly also has a low contingent liability. Uflex has around 10%, so this is also okay. Only Polyplex has a very high contingent liability, so this needs to be investigated. In debt to equity wise, the highest is of Uflex, of course, because it in fact has a negative free cash flow. So how is it putting or pumping cash back into assets? That is by borrowing higher and higher. So company is not only dipping into its own cash reserves, but also borrowing externally, and therefore they have a high debt to equity of 0.68, but still reasonable because their coverage, interest coverage, these two have to be seen simultaneously because they still have a coverage of 4, which is my benchmark. EPL has a debt to equity of around 0.41 times and has a coverage of around 9 times. That is, it can easily pay off its interest for the next 9 years with the Ebitda earned by the company. Jindal Poly and Polyplex both have a low debt to equity, therefore their interest coverage is higher. That is, their interest payment is low compared to the Ebitda it is earning or EBIT it is earning. Promoter holding and pledged shares will be looking simultaneously. Only Uflex has a lower promoter holding than 50%. Rest all three companies have a high promoter holding. Jindal Poly in fact has a 74% promoter holding. None of these companies have pledged their shares, which should not, even if pledged, should not exceed more than 20%. If we look at the ratio of the shareholding between public and institutions, we want a higher holding by the FII and DIIs. In the EPL's case, it is around approximately 28% compared to 19% by the public. Whereas in Polyplex, 34% is being held by public and only 13% or so is being held by institutions. I don't like these ratios where the public is more than the institutions. Jindal Poly is also in a similar situation where foreigners as well as domestic institutions are not holding any shares of Jindal Poly. This also suggests that they don't like this company as of today. Again, Uflex also we see a similar situation where public is holding almost 48% and no chance of institutions. In fact, rather institutions have a very low holding of around 7% taken together. Next, we'll look at both of these ratios, debtors to sales and debtor days together. EPL has to collect 18% of its current year's sales from its customers. So only 18% is pending out of the total sales done. So the lower the better. Jindal Poly is very low at around 3.4, which again suggests that this needs to be investigated. Generally around 18 to 20% is a good, around 15 to 20% is a good benchmark. Polyplex is at 14% and Uflex quite high. So although it is doing sales, it is doing it on, most of its sales are in credit. My higher benchmark or higher cutoff for me in terms of debt to sales is 30%. The company is collecting payment, as far as EPL is concerned, 69 days it is taking to collect payment, whereas Jindal is collecting quickly at around 9 days. So this again needs to be investigated as to how this particular company is managing to collect so fast from its customers, and how is it that it does not have much to be collected from the customers. Polyplex collection days is at 49, a reasonable range, whereas Uflex collection days have gone above 90, which is my benchmark. So this becomes a critical issue for me as to why the company is taking so much time to collect back payment from its customers. The net profit margin as of financial year 21 ending should be minimum around 10%. So we see Polyplex and Jindal generating around 17 and 19%. EPL's current NPM margin has fallen 8.26% and Uflex at 9.5%. So this is again a red flag, but we'll need to look at the last 5 years NPM margin on an average, or last 3 years, and then see, is this just one-off drop in net profit margin? But as we saw earlier, I generally would like to see the cash profit margin instead of the net profit margin, and that we have seen that it's almost double for EPL. That is, the cash generated is almost double of the net profits. So in that sense, the cash profit margin would be somewhere around 16 or 18%. So then that satisfies my buying into EPL. Once again, this is just an educational video for my own analysis. You are requested to do your own research, your own study, and come to your own conclusion as to how good this company may be for investment purpose. Thank you for watching this video. If you have any suggestions or queries, you can contact me on my email address, which I'll put it in the description section. If you're interested in learning from me, I have a course. You can contact me for that on my email address, and then we can get in touch. Thank you very much for watching this video. Take care.